Today, I'll be breaking down Disney's fundamentals. Recently, Disney has been in the spotlight due to its woke policies. This stance has sparked debate and potentially impacted its stock performance. While some view Disney's approach as progressive, others criticize it for possibly alienating certain audience segments. As a result, Disney's financial performance and stock market standing have become a subject of keen interest and analysis. That's what I will do today. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. In the past 10 years, Disney has seen an 82.1% rise in revenue, with a steady annual growth rate of 6.2%. Yet, when we look at net income, earnings per share, and free cash flows, there's a worrying trend. Up until 2019, Disney's profits were thriving, but the arrival of COVID in 2020 made these key performance indicators plummet, a downturn from which the company has yet to fully rebound, even after the pandemic has long gone. This raises some compelling questions. Could Disney Plus be a financial drain? Or might the "go woke, go broke" movement be playing a part in Disney's financial challenges? Let me know your opinion down in the comments. If Disney enters the ring for Analysis 2.0, I'll tackle these questions, so make sure you're subscribed to the channel. Pivoting to the profitability dimension for Disney. Historically, Disney has maintained a robust gross margin of 39.5% over the last decade. However, the latest figures indicate a dip to 33.4%. Similarly, there's a notable decline in the operating margin, now at 10.1% compared to a 10-year average of 16.5%. This contraction is also evident in Disney's free cash flow margin, which has fallen from a decade average of 7.9% to a current 4.2%. Most strikingly, the return on invested capital, which averaged 9.6% over the past 10 years, has dipped to a mere 2.8% recently. This significant decrease in ROIC is a stark indicator of the challenges Disney has been facing. Moving on to the solvency dimension. The quick ratio has been fairly stable. Disney's 10-year average stands at 0.96, with a current value at 0.99. The debt-to-equity ratio also shows stability. With a 10-year average of 0.46, the current ratio remains healthy at 0.44, indicating a solid capital structure. Looking at the net debt-to-EBITDA ratio, the current ratio is 2.49, holding close to the 10-year average of 2.3. However, the debt-to-free cash flow ratio presents a less favorable picture. It suggests that Disney would need 13.29 years to pay off its debt from its free cash flows, highlighting the negative impact of the decrease in free cash flows. Now the important fourth dimension, valuation. The enterprise value to sales reveals a 10-year average of 3.53x, while the current multiple stands below at 2.40x. In parallel, the enterprise value to EBITDA multiple has fallen from a 10-year average of 18x to close to 15x. The current multiple of 47x of the price to free cash flow multiple is significantly lower than the 10-year average of more than 200x. Lastly, the current value and the 10-year average of the price to earnings ratio are 75x and 45x, respectively. It's not surprising that almost all these multiples are trading below its 10-year averages based on the horrendous performance we're seeing from Disney stock. The fifth and last dimension is the shareholders' return. Disney had paused its dividend distributions during the COVID pandemic but announced a resumption at the end of 2023, signaling a positive turn despite the current lower dividend compared to previous levels. The current dividend yield, reflecting the smaller dividends, stands modestly at 0.3%. On the key metric of shares outstanding, Disney was proactive in repurchasing shares up until 2019. However, there was a notable increase in the share count in 2019 and 2020, leading to a dilution of shareholder value. Nonetheless, the decade's overall change in shares outstanding is just 4%, a reasonable increase. Completing our 5D analysis, the payout ratio is now at 14.6%, indicating that Disney's dividend is more than safe. Here are the ratings for the horrible Disney's first dimension metrics and their average. Here is the even more horrendous second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 2.2, a negative value. Now let's move on to Disney's DCF valuation, I employ Wall Street analysts' free cash flow projections to compute Disney's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case estimates Disney's stock fair value at $167, which is over 70% higher than the current trading price. The bull case sets Disney's stock fair value even higher at $195, suggesting a potential upside of more than 100% from the current price level. Conversely, the bear case posits a fair value at $144, indicating that even under less optimistic assumptions, Disney's stock appears undervalued. In conclusion, despite Disney receiving a 5D rating of 2.2, which suggests caution, the weighted average price target is $168, which signals that the stock could be significantly undervalued by as much as 73%. Putting all together, my final verdict is, not even with a 10-foot pole. Disney has historically shown the capacity for exceptional performance throughout its century-plus tenure, which held true up to 2019. Post-2020, however, Disney has been hit hard by multiple challenges. The pandemic shuttered its parks and resorts, its streaming service Disney Plus has yet to turn a profit, and perhaps most concerning is Disney's involvement in social and cultural wars, which is adversely affecting its business operations. I'd need to see Disney's management refocus on making money and growing the business before I think of spending another minute analyzing this business. Don't forget to subscribe to my channel and stay tuned for the next analyses.